Well, what do we have here? A faltering telecom oligopoly in Trudeau's Canada. Say it ain't so. BCE, or Bell as most people call it, reported their third quarter results on Thursday, and let's just say they've had better days. Massive impairments, constrained growth, guidance cuts, the results had it all. Folks, we're talking earnings, we're talking Bell. It's Q3 earnings season. Let's dive in. Okay, so Bell in the third quarter saw their revenues decline 1.8% on a year-over-year basis, falling from $6.1 billion to $6 billion, falling well short of analysts' estimates. The decline was blamed on falling product revenue, which fell 14.3% to $685 million. Product revenue was down as a result of lower mobile device sales and a reduction in consumer electronics purchases, with Bell claiming to be shifting away from low-margin product sales. Service revenue comparatively was up 0.1% to $5.3 billion, with growth seen at Bell Media offset by declines at Bell Communication and Technologies Services. Net earnings, meanwhile, cratered, with Bell reporting a net loss of $1.2 billion versus positive earnings of $707 million last year, a $1.9 billion decline. EPS amounted to a loss of $1.36 per share. The loss was attributed to TV and radio properties owned under the Bell Media segment, which saw total impairment charges of $2.1 billion due to a dramatic decline in advertising demand and spending in the traditional advertising market, as well as expenses related to higher severance and interest costs. On an adjusted basis, Bell posted net earnings of $688 million, a 7% decline from the $741 million recorded in Q3 of 2023. Adjusted EPS, meanwhile, amounted to 75 cents a share versus 81 cents a share last year. Analysts had called for 77 cents a share. Finally, adjusted EBITDA actually improved year over year, growing 2.1% from $2.66 to $2.72 billion. This was said to have driven a 1.7% increase in margin to 45.6%, the highest quarterly margin figure in more than 3 decades for the company. Cash flows from operations declined 6.1%, falling from just under $2 billion to $1.84 billion. Free cash flow, however, actually grew by 10% year over year, moving from $754 million to $832. Total cash and cash equivalents as of September 30th totaled $1.9 billion, an improvement over the $1.6 billion on hand as of June 30th. Available liquidity, meanwhile, is said to sit around $4.4 billion. And despite the declining financials, Bell announced a quarterly dividend of just under $1 per share, which is payable to shareholders of record as of December 16th. Dividend growth, however, has been paused, as declared earlier this month, following the announced acquisition of Ziply Fiber, with growth to resume until dividend payout and net debt leverage ratios are tracking towards target policy ranges. But it appears that Bell actually likes certain classes of shareholders more. Despite the dividend cut, the company announced yesterday that they would be renewing their normal course issuer bid for preferred shares, which will see the company repurchase up to 10% of their outstanding first preferred shares. All right, let's get into the guidance. Here's the short and sweet. It's been cut. After lower than anticipated product revenue and continued price compression in the wireless segment, Bell has revised downwards in their revenue guidance for 2024. While the company previously called for annual revenue growth of 0 to 4%, that has now been reworked, with the company expecting revenue to decline by 1.5%. All other targets remain unchanged, but they aren't exactly super strong either, save for adjusted EBITDA growth, which is expected to grow between 1.5% to 4.5%. But adjusted EPS is expected to decline anywhere from 2 to 7%, while free cash flow is expected to decline 3 to 11%. At the operational level, Bell operates through 2 segments. The first is its telecom segment, Bell CTS, which accounts for the majority of revenue at $5.3 billion in Q3. As previously mentioned, the segment was down 3% year over year. The segment saw prepaid mobile phone net subscriber activations of just under 70,000, which was its best performance since Q3 of 2019, while the mobile phone customer base hit 10.4 million, a 1.6% year-over-year improvement. Mobile phone blended average revenue per unit, or ARPU, declined 3.4% to $58.26, down from $60.28, which was blamed on sustained competitive pressures. Mobile Connect device net activations, meanwhile, tumbled 12.5%, while the total mobile connected device subscribers was up 10.9% year over year to 2.9 million. Internet subscribers also grew marginally, growing 0.9% year over year to 4.5 million. The other division is Bell Media, which obviously is the media segment. The segment accounted for $800 million in Q3, a 10% year-over-year increase. The increase was attributed to a 7.9% improvement in advertising revenue, 13.5% growth in subscriber revenue, and a 19% growth in total digital revenues. The segment also saw Crave subscriber growth of 12% year-over-year, with the on-demand television platform now boasting 3.4 million subscribers. The quarter, of course, also saw the sale of Bell's minority stake in MLSE for $4.7 billion to Rogers. While investors had expected funds from that transaction to be used to pay down debt, the company instead turned around and blew it on an acquisition, with Bell set to acquire Ziply Fiber for $5 billion in cash and the assumption of $2 billion in additional debt. Because I guess the telco didn't already have a debt problem? So how did investors respond to the earnings? Well, they're still pissed about the Ziply acquisition, which was at 14 times EBITDA, while Bell trades in the ballpark of 6 times. So 2 bad news items in a handful of days garnered not the best response. Dan Kent looks at the amount that the company's spending versus what they're taking in and makes a sarcastic comment about the management team. Well, this guy thinks it's got another $10 to $15 to fall before the stock bottoms out. Julian comments not to buy a stock for its yield. Well, the dude says it's just unsustainable. Derek, meanwhile, is taking on the role of devil's advocate, commenting that it's a higher yield than he expects to recover, while Cross Country Stocks thinks it's time to accumulate. And that's what makes a market, folks. Anyways, the stock is down 14% over the last 5 days, with the dividend yield currently sitting above 10%. Okay, so let's wrap it up. Bell had a bad quarter on top of doing a terrible acquisition earlier this week, and the market doesn't like it. Rather than spending the proceeds from the sale of MLSE on paying down debt, the company has instead doubled down. They've got under $2 billion in cash on hand and current assets totaling $8.8 billion, while total liabilities sit at $14 billion, of which $7.5 billion is debt due within the next year. How are they going to pay it? Well, I'm sure they'll figure something out. Realistically, you're probably sitting there right now and thinking it's a telco, basically an oligopoly in Canada. Bell isn't going anywhere. And to that, I say you're right. Bell, the brand, is not going anywhere. What happens to common shareholders, though, when debt holders come in and demand a restructuring is a different question. If you're long, may the odds be in your favor. All right, everybody, thank you for watching. If you enjoyed this video, please let us know what you think in the comment section. We are in the middle of Q3 earnings season. We're putting out lots of content, lots of different companies. If there's companies you want us to cover, let us know. We are here to serve you, our audience, guys. Thank you so much for watching. I love you all.